When you should do Roth conversions, part two. Part dos, as we say in Spanish. Woo, I've been a busy bee today. Woo, homecoming day for my second. Boys had tennis, daughter had soccer, and I was doing this blog post. Woo, these blog posts can take a long time, actually, but I found a couple of when you're doing blogs, my friends, and there's various different software packages you need, woo, it takes some time. But once you find it, you're like, oh, where have you been all my life? So anyway, the blogs that I will do going forward, when I do some images, they should be a little bit more crisp because I found this thing, I can't believe it, I think it's Chrome Capture, which is a wonderful screenshot program if you're using Google Chrome. So you go to the extension store and you get that. All right, so let's dive into this. This is the blog post I just did today. And again, you get this by, if you want to sign up, go to Heritage Wealth Planning, heritagewealthplanning.com. Then you go to Connect. And I send probably 3 or 4 emails a day. And then you go down here and you say your name, your email, you don't have to put your phone. You don't have to put this. Your name, your first name is fine. Your email is fine. This other stuff you don't need. But then if you look, you say, I want to sign up for your newsletter, which is basically what you're signing up for. My newsletter is my blog. You want to be interested in financial planning services, get access to software or other. You just want to say, Josh, you're the worst guy ever. You're horrible. I can't stand you. I can't believe you don't think CO2 is causing climate change. We're all going to die. All right, so let's go back to my man Pablo is. So we're at heritagewealthplanning.com. We're going to go down here. And you're going to see Roth IRAs. No, that's what my man Tom had written. So that's a different blog post. We're going to go down to when to do Roth conversions part 2 is what we're going to do. All right. So last time I did it, married filing jointly. Husband is retiring at 60. The wife is 56. She's retired as well. But they don't have any pension whatsoever. They have $500,000 in an IRA, and that's what they need to live on until Social Security kicks in, which is when he will be 67 at his full retirement age. He's going to take it, and then, oops, buddy, you're on my cord there, bud. Hold on a second. Here, let's get you over here. And then the wife will take it at there we go. And then the wife will take her spousal benefit at 63. All right, so now we're going to do married before RMDs, but with a pension. And again, so let's just go over this. I think you'll like it. And you can see it's lots of different charts and stuff here. All right, so in this scenario, we'll assume our feelers couple has $30,000 of other income starting when the husband turns 60. So we're going to assume it's a pension. It doesn't matter. It doesn't matter. If it's income of some sort, that's all that matters. So people say, I got a pension. I'm having, bond interest income. It doesn't matter. With a 50% survivor benefit. So he dies, the wife gets 50% of $30,000, which is $15,000. Now, please understand, it matters not what the source of this income is. Pension, annuity, part-time work, interest income from bank accounts, etc. Other than municipal bond income, qualified dividends, and or long-term capital gains, it's all taxed the same on the federal level. However, even municipal bond income is included in the provisional income rules when it comes to how much of your Social Security is subject to tax. Side note, I am not including state taxes in these scenarios as each state is unique when it comes to taxation during retirement. I refer you to my short book, State by State Guide to Taxes for Retirees for more detailed information. Now, that was as of the middle part of last year, 2018. It's still pretty legit, though. So remember, we're starting out with a husband at 60 and wife at 56. Both will live until they're 90. Husband has $500,000 in an IRA, which is invested entirely in the S&P 500 index. Husband's primary insurance amount is $2,900. Wife's is $1,000. Husband's going to file for Social Security at his full retirement age, which again is 67. In that case, the wife will file for her spousal benefits. So the wife will be 63, so will be reduced. So essentially, she'll get roughly 75% of half of this. So it'll be $1,450, 75% of that. Looking at about $1,100 or so. So between his $2,900, her $1,100, they're right there at $4,000 a month, and that's what their total expenses are, $4,000 a month. Now, of course, you got to factor in taxes, but we'll get to that here. Their total expenses are $4,000 a month, and I know people are going to say, "But what about health care?" I always get that whenever I always get this. It's the weirdest thing. It's like, why can't healthcare costs be part of that $4,000 a month? I don't understand why it can't be in there. What about property taxes? And then we always get, what about RMDs? It's the weirdest thing, but mostly the healthcare. What about healthcare? If you don't explicitly state you're paying for healthcare as part of that $4,000 a month, the peanut gallery gets mad. It's weird. Folks, it matters not what is included in that $4,000 a month expense. For the simple scenario, in this scenario, we're just trying to solve for whether or not these people should do Roth conversions. Assume all their expenses, all of them, healthcare, property tax, pumping up the gas, putting food on the table, is included in that $4K a month. To include healthcare. By the way, I do use $5,000 a year per beneficiary as a healthcare expense during retirement. So that, I mean, if you got $4,000 a month, that's roughly $50,000 a year. $10,000 of that is going to healthcare. That's 20% of your income going to healthcare. So I'm telling you, it's weird. People get all upset, like, you didn't have anything for healthcare. And RMDs, you're not including RMDs. It's the weirdest thing. It's like if you have RMDs, you have to spend it. It's the strangest thing. But anyway. All right, so they want to know if they should do Roth conversions. First thing we do is look at the scenarios for not doing any Roth conversions. And as you can see in the graph one below, their taxes gradually go up each and every year from about 5% in the first 10 years in retirement to 10% in the middle of retirement to well above 15% upon the death of the husband, the widow's tax trap. And so you can see, this is where when I found my new software, I'd already knock this down, so I didn't want to redo it because it is kind of a hassle, but it's a little bit blurry, but it'll get better going forward. So you get tax increases each year. You have 5%, 5, drops a little bit, and then it goes up to 10, slowly, and then when the wife survives the husband, it's 15%. Well, graph one shows a visual of the taxes increasing. It doesn't do nearly a good enough job in showing the actual taxes paid. Percentages are meaningless. It's the dollar amount that is important to know. Why do you think financial advisors only quote their fee as a percentage of assets? 1% assets of my fee sounds a whole lot better than $5,000 or even $10,000 a year, doesn't it? In graph two below, you're going to see the actual taxes this retired couple pay. Notice in 2050, the tax payment was $39,449. Yet the very next year, it jumps in 2051, it jumps to $49,441. That's a huge increase, 25% increase. Wonder what caused that. Well, if you've been following me at all, you know it's the widow's tax trap in all its glory. A 25% increase in taxes to the surviving spouse. So there's their income flows. It goes from 132 to 92, but you still have your planned distributions, which is the RMDs. So your total flows are 227 and 190. So that's about $40,000 less. And yet your taxes go from $39,000 to $49,000. So you got $40,000 less in income roughly and $10,000 more in taxes. And that's the widow's tax trap. In graph three, we see this is where it gets a little bit clearer. We got income drops here. Again, 132 to 92, and then and we just talked about the tax trap. Yeah, so you can see the tax payment, the income flows. Was that the same? Let's see, hold on. Looks like I did the same chart twice. Okay, got it, I think. Yeah, I did the same chart twice. Oh, no, okay. Yeah, it looks like I did the same chart twice. Okay, I'll have to come back and fix that. That's all right. All right, so, but the hits just keep coming. Let's look at that total on income flow in graph three. So we got total income right there, all right? See where it shows 189,000. Oh, yeah. I don't know why I didn't change that. That's odd. Okay, but anyway, see where it shows right here, total income. See what now? Remember, it's 226 when they're married filing jointly. That's their total income flows. But see, it drops down there to 189,952. What do you think that could be subject to? IRMA. Is that exactly right? The income with respect to Medicare adjustment. I think I got it down here. What's it called? We'll have to come back to that. But anyway, that's going to be your IRMA. So the income drops, but now because she's single, no longer married, that is going to put her most likely into paying more income or more premium on her Medicare, probably significantly more as well. Really, by the way, this is okay. I just talked about this is a completely bipartisan shakedown. Reagan, Clinton, Bush, Obama, Paul Ryan, Richard Gephardt. I think was he the Speaker of the House? I think he was at one point. Nancy Pelosi. It did not matter. It's all a shakedown from the politicians, without question, taking advantage of the ignorance and trust of their of the people they rule over. Now, you might be wondering why some of the information is different in graph. Oh, that's what I did. In graph 2 and graph 3. I wanted to show you this, actually. So you might be wondering why it's different. That's why I did these two graphs. Simply because it literally is one day different. And when I'm using the S&P 500 on Right Capital, is really using real numbers. I mean, it's I think it's delayed 20 minutes. But either way, so what happens here is, look, this is the taxes that that she'll pay in her last year, $59,194. This is as of the close of business on Friday. The close of business on Thursday, she paid $59,530. So why did she pay about $400 less? Because the markets fell. I mean, just that one little ripple effect can be a big deal when it comes to your overall financial planning. This is a reason why you never set it and forget it when it comes to your retirement plan. I assure you, your plan results will change and maybe drastically within a year's time. You may also be wondering why the info in Graph 2 is a lot less crisp than the info in Graph 3, and that's because, like I said, I found this thing called Chrome Capture. It's a Google Chromebook extension, and it's awesome. It took me I found a bunch of different ones. Actually, there's one called Pablo, as a matter of fact. I think, does it say Pablo in there? No. There's another one called Pablo, which I like, and I'll use that on occasion too. But the Chrome Capture is fantastic if you're using Chromebook. All right, let's see here. All right, so now let's go down to Graph 4 and see what the net results of our couple's legacy. Notice the circle right there. That's the traditional IRA balance that they're going to leave to their heirs, $945,000. Yeah, like see, it says Pablo right there. That's pretty cool. So that's another chart, and I had to use the Pablo software simply because it says Pablo, like your old buddy Pablo down here. So anyway, that's the which is good. It's another Google Chrome thing if you want to use it on the extensions. It lets you add text pretty easily, circles, whatnot. Anyway, so in this case, again, we're not doing any conversions. You can see they got $945,000 in a traditional IRA they're leaving to the heirs, and $4 million that they're leaving tax in a taxable account to the heirs. And so that's fantastic because they don't have to pay, the heirs don't have to pay money on that $4 million because of the step up in basis. But the people, the husband and wife, Josh and Charlotte, had to pay tax on this all the years because of the ordinary income, dividends, taxable interest, and long and short-term capital gains. So they're going to leave, what's that, a net, what do we got here? About $5 million, yeah, about $5 million to the heirs, of which $900,000 is taxable as ordinary income. Yeah, $4.97 million. All right, so what you'll find in Graph 5 below is a tax visual when these folks begin starting to convert $35,000 a year to Roth. Note the drop off in taxes. That's pretty good, right? And that's when the IRA is fully converted over to the Roth. However, there is always this floor because they still have that $30,000 pension. And in this case, we don't have any increase in the pension, no cost of living adjustment or anything. It's just flat. But they'll never get above below 2.5% taxable income simply because the pension essentially wipes out their standard deduction, which means all their other income becomes taxable, which also will make their other Social Security benefits taxable as well. All right, but you can see in Graph 6, the taxes they pay are significantly lower later in life than what they would have been doing without doing the Roth conversion. So remember, before it's $39,000, here's $6,800. Remember, it's $49,000 when the husband died. Here's $14,000. That's a pretty significant difference. But because they did the Roth conversions, the vast majority of their liquid wealth is in the Roth, which it means it's all tax-free. Tax-free to them while alive, tax-free to the heirs as well. Graph 7 shows us what their liquid estate is at death. Nearly $4 million going to the heirs, all tax-free. So you can see Graph 7, nearly $5 million $4 million going to the heirs of Roth, but another $1.3 million going to the heirs as part of an of a taxable account. So with a step up in basis, that's all tax-free. So after doing Roth conversions, the heirs are going to receive $5.26 million, all tax-free. Come here, buddy. Puppy. Oh, no, okay. Oh, in case you're wondering what rate of return I'm using for the S&P 500, it's 7.5% with a standard deviation of 16. I figure 2 to 2.5% dividend yield plus a 5 to 5.5% earnings growth year over year, 7.5%. Nothing fancy, and that's nominal too because I'm using a 3% inflation rate. So after inflation, your real return is 4.5%. That's not significant. And look, just because they're not spending any money, they're 60 years old, 30 years of not spending money. They're gonna that $500,000 they have in his IRA is going to grow at 7.5%. It's going to grow to a lot of money, my friends. All right, so now let's go to the fun stuff and look at the 1040s. All right, so what you see here, again, this is no Roth conversions. Social Security benefits $102,000. You can see that. Taxable Social Security is $87,000. So 85% of their Social Security is subject to taxation. And the reason for that is because they have this huge RMDs right there. This is in 2050, by the way, the last year that the husband's alive. And look at that, AGI 305. Look at that. Now they have standard deductions, and this is personal exemption. Everyone says, but they don't have qualified business income. This is personal exemption. Line 9 until 2026 is QBI. After that, it's going to go back to personal exemptions. But we don't know what the tax reform is going to look like. So Right Capital says we're just not going to create something out of the blue. So anyway, they got 305,000 as AGI. We don't know if they'll be subject to Medicare premiums, the IRMA at that point, simply because we don't know what the inflation rates are going to be and all that. But stay with me here. So they're going to pay $39,000 of income tax on 305,000 of AGI, but then you got to add another 15,000 because of the difference in Social Security benefits and what's taxed. So they're going to pay $40,000 roughly on $320,000 of income. What's that, about 12%? That's not so bad. Let's see. All right, so line 7 we talked about. That's their adjusted gross. Yeah, okay, gotcha. All right. Now scroll down to line 15. You see their total tax. Yeah, we talked about. Okay, now let's look at line graph 9 right here. Notice anything different. So here we got, this is again in 2051. So the husband's dead. So she only has $77,000 of Social Security benefits, of which again 85% is taxed because they have this big required minimum distributions. So look at the RMDs here, 123. Hold on a second. The RMDs here are 112, $9,000 difference. So a couple reasons for that. Hey, it's okay. Is because she is 4 years younger, so she'll have a different RMD table. And that's one of the reasons. On top of that, though, the money did grow for another year, had another year of growing. So there's a couple reasons the RMD is different. But anyway, so now we got RMDs 112. We have taxable Social Security still at 85% at $65,000. So she has $284,000 of AGI. She's certainly going to be in IRMA for sure. So that's going to be a big thing. And now she pays $49,000 of taxes. Oh, yeah, it's nuts. All right, so what do we do about this? Well, we start converting without question. But Josh, Rick Edelman says don't convert to Roth. I can hear the peanut gallery scream. Yep, and that's wrong. So here's graph 10 with Roth. All right, so this is 2050 while the husband's still alive. They have $102,000 Social Security benefits, but only about 65% is taxable. So $102,000 of Social Security benefits, only $68,480 is taxable as income, which is great. So you take their pension, $30,000, that hasn't changed. Because they have over a couple million or a million or something like that in taxable investments, they will have some dividends and some interest and whatnot. That's $20,000 plus that, plus their taxable Social Security. They got $134,000 as their AGI. Take out your standard deduction, your personal exemption. Their taxable income is only $84,000. Now, how much did they take for the Roth? It completely is irrelevant. It's not going to show up here because it's not taxable. Roth just doesn't go into the 1040. It's awesome. So in this case, they're paying $6,861 in taxes. Remember, $6,681. They were paying $39,000 before. I mean, that's freaking nuts how much less it is. So they pay. Everything else is the same. They're still living on the same amount of money, but because it comes from a Roth as opposed to a non-Roth, it's going to make their taxes a whole lot less. They'll make a whole lot less their Social Security taxes. They have no RMDs. That's great. All right, so we've seen that. Now let's look at graph 11. All right, so look how much clearer that is. This again when I found that thing. So here's graph 11. Here's her Social Security benefits. 77,000 because now she is just a single taxpayer and 85% of that is still subject to taxation. All right, so that's the widow's tax trap. Even doing Roth conversions is not going to free her from having to pay. Let's see, 62,000 Social Security is taxable, whereas before is 68,000 was. But before she had 102,000 Social Security. Now she only got 77,000. So she has 25,000 less of Social Security, but only 6,000 less of which is taxable. Tell me that's not crazy. But at the end of the day, she's still only paying 14,000 in income taxes on a taxable income of $100,000. That's not so bad, man. So she definitely is not subject to IRMA here, if that makes sense. So you can see how that works. And I'm again the Roth conversion, but you think that's it. So if we go back to the net, I think I got the net worth. I think that's 5.265 million in net worth with doing the Roth versus $5 million in net worth, not doing the Roth. Oops, not that one right there. Yeah, right here, $5 million in net worth. Pablo thing keeps showing it right there. $4.9 million in net worth, not doing the Roth. So they got well over $250,000 more in net worth, leaving to the heirs by doing the Roth. And again, their heirs are going to lose at least $250,000 on taxes here. So basically, $500,000 more in net worth by doing the Roth. All right, so they got more net worth to the heirs. Watch this though, and I calculate all the taxes. Look at this. So they have to pay, with the Roth conversions, they pay a total of $293,000 in tax. Without the Roth conversion, $685,000 in tax. That's a $400,000 difference in taxes. So they have a net worth of leaving $500,000 more to the heirs because they paid $400,000 less in taxes. And this does not even include the Medicare IRMA stuff either. So the benefits of doing the Roth here are simple. Higher net worth during life, higher legacy to heirs at death, hundreds of thousands less in taxes, less likely to fall into IRMA, and certainly more control because they get to choose when to pay the tax. It's a tax man. But don't worry, we're far from being done with all this stuff yet. We'll run a married couple in their 70s next and say it's a two-way for them, and we'll do single taxpayers later after that as well. So stay tuned. We're going to do part 3, 4, 5, 6. I think I was going to do, I had some other ideas I was thinking about. I forgot what they were. But anyway, we're going to have about probably 10 blog posts, which we'll throw together in a book here pretty soon. So stay with me. Thanks, then.